Welcome friends. Today we are going to discuss time value component. Time value component is affected by many things. Let us see them one by one. These are interest rate, underlying price, strike price, time to expiry, call or put, and volatility. Time value is affected by interest rate. There is a cost of holding the underlying to expiry, and interest rate has some effect on time value component due to this. Let us see how it affects. If we buy an option, what do we have? We have a right. When we buy a call, it gives us right to buy. When we buy a put, it gives us right to sell an asset on a future date. So till that date, there will be some interest levied. There is going to be some cost involved. This cost will be reflected in options price. If you want to buy the underlying now, then funds will be used. Those funds, if not used, will yield some interest, and this interest is included in the cost of option. Okay, so this is interest rate. Then next factor which affects time value component is price of underlying. As price of underlying moves up or down, time value component also changes. As prices move, there are changes in people's expectation. As expectations change, time value component also changes. Okay. Then strike price. Strike price also affects time value. There are in the money, out of the money, and at the money strikes. Time value component changes for each of them. At the money options have highest time value among all the strikes. As strike moves away from the spot on either side, time value decreases. We have discussed this earlier. The next factor affecting option prices is time to expiry. Time to expiry affects time value in a big way. Time to expiry means number of days remaining from current date till expiry date of the options contract. It has direct relationship. More number of days to expiry means more time value. Like a travel insurance, for example, when we go to foreign countries, we need to take a travel insurance. And cost of insurance depends upon duration for which we are taking insurance. For a trip of 10 days, it may be 1000 rupees. For a trip of 20 days, it may be 2000 rupees. For a trip of 3 months, it may be around 5000 rupees. So, time value component changes with duration to expiry, time to expiry. Another factor affecting time value is whether it is a call option or put option. Fear and dividends make calls and puts to be priced differently. When there is more fear, what will get more affected? Call or put? When there is more fear, puts will be highly priced because people will rush to buy puts. So puts will get higher premiums. When it is strongly bullish market, call seller will demand higher premiums and call buyers will be willing to pay higher premiums as there is hope of further higher prices. Then there is volatility component. Volatility means movement in coming days. More the volatility expected, higher is the premium. There is lot to discuss in volatility. We'll discuss it at appropriate time. But Take this example. When we take a health insurance, if somebody has associated comorbid conditions like diabetes, hypertension, then their insurance premium is higher because this is considered as high risk factor. So similarly, high volatility is high risk. That's why there is increase in premium. Now, among these factors mentioned, what can be easily controlled and what cannot be controlled? First one is interest rate. How many times does interest rate of RBI changes? Meetings are scheduled every quarter, but changes in interest rates are very rare. Even when they change, how much are chances that interest rate will change while you are in options trade? Once in a long time. Maybe once in a year or once in 2-3 years. So we may consider interest rate as fixed factor which doesn't change very frequently. That means we can safely consider interest rate as a fixed factor. Next is underlying price. Is it fixed or dynamic? Price of underlying is dynamic. It changes every second. It cannot be fixed factor. So interest rate is fixed and price of underlying is dynamic, which keeps changing. Next factor is strike price. Will it change once we are in trade? It will not, because strike price is fixed and we select strike price at the time of execution. Time to expiry. Is it fixed or not fixed? Time to expiry is known and it is fixed on a particular date. It reduces at known pace. There cannot be any variation due to any reason. Clock keeps ticking continuously. So time to expiry is considered to be fixed. It is fixed on particular date and particular time which is declared beforehand, and it will not change. Now next factor, whether it is call or put. Is it fixed? Yes, it is fixed. It cannot change. Once a call is bought, it remains call. It doesn't become put. So this is also a fixed factor. Last factor is people's expectation. Volatility comes from people and their expectations, and it changes every second. It is extremely variable factor. What we think changes within an hour or sometimes within 5 minutes. Am I right? So people's expectation is highly volatile. So time value component is affected by many factors like interest rate, underlying price, strike price, time to expiry, whether it is call or put, and volatility. Out of these, only two parameters are variable: underlying price and volatility. Can we control underlying price? Well, we can manage risk reward ratio. We can control underlying price. We can manage underlying price by identifying trend, taking trade in direction of trend, planning to buy in demand areas or buying high probability breakouts, and selling into supply areas or resistances. This way, price of underlying can be controlled using technical analysis. Only thing which remains is how to control volatility. Other things are fixed apart from underlying price, and volatility is very important thing for option trader. Decision to buy or sell depends upon volatility. Now we will focus on volatility. It is most important aspect of options trading. We will dig deep. Any questions for now?